Welcome to the Finance Wisdom Summaries. The Little Book of Common Sense Investing, Introduction to the 10th Anniversary Edition. In the introduction to the 10th Anniversary Edition of his book, John C. Bogle lays out the core principles of his investment philosophy. He argues that successful investing is rooted in common sense, not complexity. The most effective strategy, he asserts, is to own a fund that holds all of the nation's publicly traded companies at a minimal cost, and to hold it for a lifetime. Such a fund is known as a traditional index fund, or TIF. This approach eliminates the risks of picking individual stocks, emphasizing certain market sectors, or selecting managers, leaving only the inherent risk of the stock market itself. Bogle introduces two fundamental, yet often overlooked principles: the magic of compounding investment returns and the tyranny of compounding investment costs. He uses an example to demonstrate that a 7% annual return compounded over 5 decades can turn a dollar into $30. However, he warns that high investment costs can severely erode these returns. He states that before costs, the market is a zero-sum game, where one investor's gain is another's loss. After deducting the high fees, commissions, and other expenses paid to financial intermediaries, the game becomes a loser's game for investors as a group. Bogle's solution is to minimize these costs to maximize the share of returns that reach the investor, or Main Street. He advocates for staying out of the casino of short-term speculation and embracing a long-term buy-and-hold strategy with low-cost index funds. How to apply these lessons in your daily life. Focus on what you can control. You cannot control the market's returns, but you can control the costs you pay and your own behavior. Prioritize low-cost investments. Practice delayed gratification. Understand that the magic of compounding works over a lifetime, not overnight. Resisting the urge to chase short-term gains and sticking to a long-term plan is crucial for wealth accumulation. Be skeptical of advice that encourages action. The financial industry profits from activity. If an advisor or a hot tip encourages frequent buying and selling, remember Bogle's maxim: don't do something, just stand there. Chapter 1. A Parable. This chapter presents the Gotrocks family parable, a folksy story illustrating the fundamental flaw of active management. Initially, the Gotrocks family owns 100% of all businesses in the U.S. and reaps 100% of the dividends and earnings growth. Their wealth compounds beautifully. However, the arrival of helpers, brokers, money managers, and consultants, convinces family members to trade stocks among themselves, seeking to outperform one another. These helpers charge commissions and fees, which, along with new capital gains taxes from frequent trading, begin to consume a portion of the family's overall return. The family's wealth, once growing at 100% of the market's return, starts to grow at a slower pace. The wise old uncle advises the family to fire all their helpers and return to their original strategy of owning all businesses and holding them forever. This, the parable concludes, is exactly what a low-cost index fund does. How to apply these lessons in your daily life. Simplify your finances. The parable shows that adding layers of complexity, like multiple advisors, frequent trading, and specialized funds, often leads to diminished returns. Look for the simplest, most direct path to owning the market. Question fees and commissions. Every fee you pay, whether for a broker, a managed fund, or a consultant, directly subtracts from your personal return. Be diligent in understanding and minimizing all investment costs. Adopt a passive mindset. Realize that successful investing is not about outsmarting others, but about letting the inherent growth of the market work for you. Don't be swayed by the excitement of stock picking. Chapter 2. Rational Exuberance. Bogle expands on the core idea that, in the long run, shareholder gains must match business gains. He distinguishes between two components of stock market returns: investment return, the real growth of business through dividends and earnings, and speculative return, changes in investor sentiment reflected in the price-to-earnings, or PE ratio. While speculative return can cause wild short-term swings in the market, he presents data showing that over the long term, since 1900, the vast majority of the market's return has come from the steady upward trend of business fundamentals. He quotes Benjamin Graham's timeless metaphor that, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. The chapter emphasizes that ignoring the sound and fury of short-term market fluctuations and focusing on the long-term economics of business is the path to success. How to apply these lessons in your daily life? Make cost your primary filter. When evaluating any investment, whether it's a mutual fund, an ETF, or a retirement plan option, start by looking at the expense ratio and other fees. View low costs as a form of guaranteed return. While a fund's outperformance is never guaranteed, paying less in fees is a certainty. Every dollar not spent on fees is a dollar that stays in your pocket and continues to compound. Avoid star chasing. Don't be tempted by funds with a recent history of high returns, as the data shows this is not a reliable indicator of future success. Trust the data on costs, not the fleeting promise of past performance. Chapter 6. Dividends are the investor's best friend? Bogle reveals the immense power of dividends in long-term wealth creation. He presents data showing that since 1926, dividends have accounted for a remarkable 42% of the stock market's total return. Compounded over time, an initial investment of $10,000 would have grown to over $1.7 million from price appreciation alone, but a staggering $59.1 million with dividends reinvested. He highlights the stability of corporate dividends, which have shown a smooth upward trend over the last 90 years with only 3 significant drops. He then contrasts this with actively managed funds, which, due to their high expenses, often confiscate a huge portion or even all of the dividend income they earn. A low-cost index fund, on the other hand, allows almost all of the dividend income to flow directly to the investor. How to apply these lessons in your daily life? Prioritize dividend reinvestment. If you are in the accumulation phase of your life, automatically reinvesting dividends is one of the most powerful tools for long-term compounding. Look for yield, not just growth. While market narratives often focus on price appreciation, remember that a steady stream of dividend income is a vital component of a portfolio's total return. Choose index funds for dividends. If you want to maximize the dividend income from your portfolio, a low-cost index fund is the most effective vehicle, as it won't be eroded by high management fees. Chapter 7. The Grand Illusion. This chapter uncovers a grand illusion. The returns reported by mutual funds are almost never the returns actually earned by their investors. Bogle explains the difference between a fund's time-weighted return, the return of the fund itself, and an investor's dollar-weighted return, the return of the average investor, factoring in when they put money in and took it out. He shows that during a strong 25-year period, the average fund investor earned a shocking 1.5 percentage points less than the average fund's reported return. This shortfall is due to timing and selection penalties. Investors, driven by emotion and influenced by aggressive marketing, tend to pour money into hot funds at market peaks and pull it out during market crashes, thereby buying high and selling low. The index fund, with its simple buy and hold philosophy, helps eliminate this self-sabotaging behavior. How to apply these lessons in your daily life? Avoid market timing. Trying to predict when to enter or exit the market is a fool's errand. The data proves that most investors, even professionals, fail at this. Adopt a stay-the-course mindset regardless of market conditions. Resist the urge to chase performance. When a fund is heavily advertised for its spectacular recent returns, remember that this is often the worst time to buy. This is a classic example of buying high. Let the index fund be your emotional shield. By committing to a passive, all-market index fund, you remove the constant temptation to make emotional decisions based on short-term market movements or media hype. Chapter 8. Taxes are costs too. Bogle adds another layer to his relentless rules of humble arithmetic: taxes. He points out that actively managed funds, due to their high portfolio turnover, the average stock is held for less than 2 years, are astonishingly tax inefficient. Frequent trading generates capital gains, which are then distributed to shareholders, often as short-term gains, taxed at a higher rate.
This creates a significant drag on returns, especially for investors in taxable accounts. In contrast, a traditional index fund has a very low turnover rate, around 3%, because it simply holds the market. This buy and hold strategy results in far fewer capital gains distributions, making the index fund highly tax efficient. Bogle shows that over a 25-year period, the tax burden on active funds was 3 times higher than on index funds, leading to a massive gap in after-tax returns. How to apply these lessons in your daily life? Be mindful of tax efficiency. For investments in taxable accounts, choose low-turnover, tax-efficient vehicles like index funds. Save your higher turnover investments for tax-advantaged accounts like IRAs or 401ks.
Think like an owner, not a speculator. When you buy a stock or an index fund, you are buying a piece of a business. Focus on the long-term value creation of that business, not on its daily price fluctuations. Ignore the noise. The media and financial news thrive on volatility and excitement. Remind yourself that these are part of the expectations market and have little to do with the real market of business fundamentals. Reframe your view of market downturns. A market crash is not a loss of business value, but a temporary decline in investor sentiment. For a long-term investor, it can be seen as an opportunity to buy assets at a lower price. Chapter 3. Cast your lot with business. This chapter presents the practical application of the previous chapter's philosophy. Bogle argues that the simplest and most effective way to cast your lot with business is to buy and hold a total stock market index fund. He champions Occam's razor, the principle that the simplest solution is often the best. He shows that the S&P 500 index and a total stock market index, like the Dow Jones Wilshire Total Stock Market Index, have had nearly identical returns over the long term, a 0.99 correlation since 1926. This is because the S&P 500 already represents about 85% of the total market value. He also presents data from S&P's Speeder report, which shows that an astonishing average of 90% of actively managed funds underperformed their benchmark indexes over a 15-year period. The message is clear, that the index fund is a winner's game that is guaranteed to outpace the returns of investors as a group. How to apply these lessons in your daily life. Embrace simplicity. Choose an investment strategy that is easy to understand and execute. A low-cost, broadly diversified index fund is the epitome of this simplicity. Trust the data. The statistics on active management versus indexing are overwhelming. Do not let wishful thinking or the promise of beating the market override the hard evidence that most professionals fail to do so after costs. Be proud of being average. The goal of an index investor is not to be a star stock picker, but to capture the market's average return. Since most active investors fall short of this average, a commitment to indexing is a high probability path to being a winner. Chapter 4. How most investors turn a winner's game into a loser's game. Bogle delves into the relentless rules of humble arithmetic to explain precisely how investors lose. He reiterates that before costs, beating the market is a zero-sum game, and after costs, it becomes a loser's game. He meticulously breaks down the costs of investing, management fees, operating expenses, sales charges or loads, and often hidden costs of portfolio turnover. He estimates that the all-in cost of owning an actively managed fund can be as high as 2 to 3% per year. Using a 50-year investment example, he shows that a 2% annual cost can consume over 60% of the potential return, leaving the investor with less than 40% of the market's wealth creation. He emphasizes that the investment industry, which puts up 0% of the capital and assumes 0% of the risk, is taking an excessive share of the returns. How to apply these lessons in your daily life. Calculate your all-in costs. Go beyond just the expense ratio. Factor in sales loads, trading costs, and the tax implications of frequent capital gains distributions. These hidden costs are the primary reasons for underperformance. Embrace the zero-sum reality. Understand that the person on the other side of a trade is trying to make money at your expense. By minimizing trades and holding an all-market portfolio, you remove yourself from this high-stakes competition. Advocate for low costs. Use your voice as an investor to demand lower fees and transparent practices. Support fund companies and platforms that prioritize low-cost, investor-centric models. Chapter 5. Focus on the lowest-cost funds. This chapter focuses on the most reliable predictor of future fund performance, cost. Bogle argues that while a fund's past performance is not a reliable indicator of its future returns, its costs are constant and predictable. He provides data from a 25-year study showing that funds in the lowest cost quartile consistently outperformed those in the highest cost quartile. He notes that the gross returns before costs of all funds tend to be similar, but the net returns vary wildly based on the fees they charge. Furthermore, he points out that higher cost funds are also associated with higher risk. He cites Morningstar's analysis confirming that low-cost funds consistently beat high-cost funds across all asset classes and time periods. The message is clear that if you can only use one factor to choose a fund, make it cost.
How to apply these lessons in your daily life. Understand the tax implications of your decisions. Be aware that selling investments for a profit or even receiving capital gains distributions from an actively managed fund can trigger a tax bill that further erodes your return. Hold the line. The most tax-efficient strategy is to hold your investments for the long term. This allows for tax deferral and, in some cases, such as when assets are bequeathed to heirs, can eliminate capital gains taxes entirely. Chapter 9. When the good times no longer roll. This chapter addresses the critical issue of future returns. Bogle argues that the high returns of the past several decades are unlikely to be repeated. He breaks down the three sources of stock returns: dividend yield, earnings growth, and speculative return, the change in the P/E ratio. He notes that since 1974, a huge portion of the market's return has been driven by a massive expansion in the P/E multiple, a factor he believes is highly unlikely to repeat. With current dividend yields and expected earnings growth at lower levels than historical averages, he projects a much more subdued return for stocks, around 4% annually, and bonds, around 3.1% for the coming decade. He demonstrates that in an environment of lower returns, the tyranny of compounding costs becomes even more devastating, potentially consuming all of an actively managed fund's real return. How to apply these lessons in your daily life. Adjust your expectations. Be realistic about future returns. The days of double-digit annual returns may be over, and expecting them can lead to poor decision-making. Double down on costs. In an era of lower market returns, every basis point of cost becomes even more important. Minimizing fees is the single most powerful action you can take to preserve and grow your wealth. Don't chase risk for higher returns. The promise of higher returns from riskier, more speculative investments is tempting, but the evidence shows that in a lower return environment, this is even more of a loser's game. Stick to your low-cost, diversified plan. Chapter 10. Selecting long-term winners. Bogle directly addresses the common belief that, while most funds fail, I'll be the one to pick the winners. He presents a compelling case against this idea by analyzing the long-term records of 355 equity funds that existed in 1970. The results are startling. 80% of those funds had gone out of business by 2016. Of the 74 that survived, only 10 had outperformed the S&P 500 index by more than 1% annually, and only 2 by more than 2%. He highlights the stories of Fidelity Magellan and Contrafund, showing that while they had periods of spectacular returns, their performance eventually reverted to the mean as their assets grew. This leads to his famous maxim: don't look for the needle in the haystack, just buy the haystack. The haystack, of course, is a total stock market index fund, which would have beaten or matched the returns of 345 of the 355 original funds. How to apply these lessons in your daily life. Acknowledge the terrible odds. The chance of picking a fund that will consistently outperform the market for decades is statistically minuscule. Don't let overconfidence blind you to this reality. Embrace the haystack. Acknowledging that you cannot reliably find the needle, the winning fund, is liberating. The logical response is to simply buy the entire market through a low-cost index fund and guarantee yourself a top-tier return relative to most other investors. Think about fund longevity. An actively managed fund can close or merge due to poor performance, forcing you to make a new decision and potentially realize capital gains. An index fund, by its very nature, is designed to exist forever. Chapter 11. Reversion to the mean. This chapter dives deeper into a central theme of the book, the principle of reversion to the mean, RTM. Bogle presents data showing that a fund with superior performance over a short period is highly unlikely to maintain that performance in the next period. He analyzes 2 consecutive non-overlapping 5-year periods and finds that a shockingly low percentage of top quintile funds remained there. In fact, a significant portion of the previous period's winners fell to the bottom quintile or went out of business entirely. He attributes this phenomenon to the randomness of returns, which most investors fail to recognize due to a cognitive bias toward causal explanations. He argues that manager skill is not a persistent factor. Rather, most short-term success is a product of luck. This chapter reinforces that chasing recent performance, a strategy widely promoted by the industry, is a proven recipe for disappointment. How to apply these lessons in your daily life? Don't fall for stars. Be skeptical of investment services that rate funds based on recent performance, like Morningstar's star ratings. These ratings are heavily biased toward short-term success, and the data shows that these stars often become tomorrow's losers. Understand randomness. When a manager has a few years of stellar returns, it is statistically more likely to be luck than skill. Don't invest in a fund just because it was a recent winner. Think about the why. Ask yourself why a fund has performed well. Is it because of a skillful manager or because its specific style, e.g. tech stocks, was in favor during that period? If the latter, it's a good bet that RTM will eventually bring its returns back to earth. Chapter 12. Seeking advice to select funds. Bogle examines the value of professional financial advice, particularly from brokers and registered investment advisors, RIA.
While acknowledging that good advisors can provide valuable services like asset allocation, tax planning, and emotional support, he remains skeptical of their ability to consistently pick market-beating funds. He points to a study showing that investors who relied on brokers actually had significantly lower returns than those who invested directly. He attributes this to brokers' inherent conflict of interest. They are in business to sell products and generate commissions. He uses the Merrill Lynch debacle as a stark example of this, where the firm aggressively marketed new, high-risk funds at the peak of the dot-com bubble, leading to catastrophic losses for its clients. Bogle concludes that the best advisors are those who recommend low-cost index funds and help clients stick to a simple, long-term plan, thereby earning their fee by preventing costly mistakes, not by attempting the impossible task of beating the market. How to apply these lessons in your daily life? Vet your advisor carefully. If you choose to hire an advisor, ensure they operate on a fee-only basis and are held to a fiduciary standard, meaning they are legally required to act in your best interest. Don't pay for stock picking. Recognize that the primary value of a good advisor is in behavioral and planning assistance, not in selecting market-beating investments. An advisor who recommends low-cost index funds is often a better choice. Be your own advocate. Educate yourself on the principles of sound investing. By understanding Bogle's message, you can better evaluate an advisor's recommendations and ensure your interests are being put first. Chapter 13. Profit from the majesty of simplicity and parsimony. This chapter summarizes the lessons learned and brings them together into a final, powerful argument for simplicity and frugality in investing. Bogle reiterates that costs matter, past performance doesn't predict the future, returns revert to the mean, and professional advice is often unreliable for fund selection. He uses a Monte Carlo simulation to demonstrate that the odds of an actively managed fund outperforming a low-cost index fund decrease dramatically over time, dropping to just 2% over 50 years. He introduces his phrase, the majesty of simplicity in an empire of parsimony, emphasizing that the winning strategy is to embrace the elegance of a simple, low-cost approach. He also cautions that not all index funds are created equal, highlighting a wide range of costs and sales loads even among S&P 500 index funds. He concludes by urging investors to do your best to diversify to the nth degree, minimize your investment expenses, and focus your emotions where they cannot wreak havoc. How to apply these lessons in your daily life? Build a core portfolio of low-cost index funds. The evidence is overwhelming.
Use a broad market index fund, or a combination of a few, as the foundation of your investment portfolio. Scrutinize even index funds. Don't assume all index funds are the same. Compare expense ratios, sales loads, and fund company reputations. Choose the lowest cost option from a reputable provider. Remember the core tenets. Diversification, low costs, and a long-term mindset are the cornerstones of successful investing. Refer back to these principles whenever you feel tempted to deviate from your plan. Chapter 14. Bond Funds. Bogle extends his common sense principles to bond funds. He argues that the relentless rules of humble arithmetic apply even more forcefully here because bond returns are primarily driven by one factor: the prevailing level of interest rates. He presents data showing that, just like with stocks, actively managed bond funds consistently underperform their benchmark indexes. He attributes this to the same culprit: costs. The average shortfall in returns for actively managed bond funds is almost entirely explained by their higher expense ratios. He also explains why an investor should hold bonds: for diversification, downside protection, and a steady income stream. He advises investors to use low-cost bond index funds to capture the market's return in this asset class, just as they do with stocks. How to apply these lessons in your daily life? Diversify with bonds. Incorporate a bond component into your portfolio to reduce overall volatility and provide an anchor during stock market downturns. Choose bond index funds. Don't believe the hype that bond managers can consistently beat the market. The low-cost index fund is the most reliable way to capture the return of the bond market. Align bond type with your goals. Choose bond funds based on your risk tolerance and time horizon, short, intermediate, or long-term, and always prioritize high credit quality. Chapter 15. The Exchange-Traded Fund, or ETF. This chapter addresses the rise of exchange-traded funds and distinguishes them from traditional index funds, or TIFs. While ETFs can be a low-cost and tax-efficient way to invest in a broad market index, Bogle cautions that their design, which allows for real-time trading, often encourages short-term speculation rather than long-term investing. He calls the ETF a wolf in sheep's clothing that has strayed far from the original buy-and-hold philosophy of indexing. He highlights the double whammy of ETFs: the temptation to engage in counterproductive market timing, chasing hot sectors, and the accumulation of heavy brokerage commissions from frequent trading. He concludes that while a broad market ETF can be an excellent long-term investment, the vast majority of ETFs are wealth depleting for investors who fall prey to the temptation to trade them. How to apply these lessons in your daily life? Use ETFs wisely. If you are a long-term investor making large, infrequent contributions, a low-cost, broad market ETF can be a great tool. Resist the urge to trade. The ability to trade an ETF all day long does not mean you should. Frequent trading is a losing game that benefits brokers, not investors. Be wary of specialized ETFs. Avoid complex or narrow sector ETFs that promise spectacular returns. These are often marketing gimmicks designed to capitalize on short-term fads. Chapter 16. Index funds that promise to beat the market. This chapter tackles the new paradigm of indexing, so-called smart beta or factor funds that promise to beat the market by weighting their portfolios differently than traditional market capitalization weighted indexes. Bogle argues that these are essentially active strategies masquerading as passive index funds. He shows that historical data mining can make a strategy look good in the rearview mirror, but that this success is rarely repeatable due to reversion to the mean. He presents a comparison of smart beta funds to the S&P 500 index fund over a decade, showing that after adjusting for risk, the traditional index fund was still the winner. He warns investors against being tempted by these new, complex, and higher-cost products, quoting a military theorist, "The greatest enemy of a good plan is the dream of a perfect plan." He urges investors to stick to the good plan of a traditional, low-cost index fund. Stick to the basics. Don't be fooled by the marketing of smart or enhanced indexing. The most effective and reliable strategy is the simplest one: a broad market, market cap weighted index fund.
Question complexity. Whenever a product promises higher returns through a new or complex strategy, be skeptical. The burden of proof is on the promoter to demonstrate how their solution can consistently overcome the drag of costs and the power of randomness. Trust the simple arithmetic. The core lesson of the book holds true here. All investors as a group earn the market's return, and any attempt to deviate from that average is a bet that is more likely to fail than to succeed. Chapter 17. What would Benjamin Graham have thought about indexing? Bogle seeks to legitimize his investment philosophy by linking it to the ideas of Benjamin Graham, the father of value investing and author of The Intelligent Investor. He points out that while Graham is known for stock picking, he was highly skeptical of the ability of the average investor or professional to consistently succeed at it. Graham recommended that the defensive investor be satisfied with a reasonably good return from a diversified portfolio and avoid the temptation to speculate. Bogle notes that Graham's advice to own and hold a diversified list of securities and to focus on the long-term fundamentals of a business is a perfect precursor to the concept of the index fund. Bogle shares an anecdote from Warren Buffett, Graham's most famous student, who confirmed that Graham himself had privately endorsed the index fund concept late in his life, recognizing that the market had become too efficient to be consistently beaten. How to apply these lessons in your daily life? Embrace the defensive investor mindset. Acknowledge that you may not have the time, skill, or temperament to succeed at active investing. This is not a failure, but a wise and realistic assessment of your capabilities. Seek a satisfactory return. The goal of investing should be to build wealth reliably, not to achieve spectacular but ultimately unsustainable returns. The market's long-term return is a highly satisfactory outcome. Draw wisdom from history. The principles of sound investing are timeless. The lessons from figures like Benjamin Graham and Warren Buffett, who both endorse low-cost indexing, provide a powerful foundation for your own strategy. Chapter 18, Asset Allocation 1, Stocks and Bonds. This chapter moves from the what to the how of investing, focusing on asset allocation, the split between stocks and bonds in a portfolio. Bogle considers this to be the most important decision an investor can make, citing a study that found it accounted for 94% of the difference in portfolio returns. He uses Benjamin Graham's advice of a 50-50 stock-bond allocation as a starting point, with a range of 25-75 to 75-25. He stresses that the optimal allocation depends on two factors: your ability to take risk based on your financial situation and time horizon, and your willingness to take risk, your personal temperament. He also presents a powerful example showing how a low-cost portfolio with a more conservative allocation, for example 25% stocks, 75% bonds, can generate a higher net return than a high-cost portfolio with a more aggressive allocation, for example 75% stocks, 25% bonds. This highlights the critical linkage between costs and asset allocation. How to apply these lessons in your daily life? Determine your risk tolerance. Honestly assess your ability and willingness to handle market volatility. Don't simply choose a high-risk portfolio for the promise of high returns if it will cause you to panic and sell during a downturn. Start with a simple allocation, a 50-50, 60-40, or age-based split. For example, 100 minus your age in stocks can be a great starting point. The simplicity of this approach makes it easy to maintain and understand. Let costs inform your decisions. When considering your asset allocation, remember that a low-cost approach allows you to take less risk to achieve the same or better net return. Chapter 19, Asset Allocation 2. Bogle continues the discussion on asset allocation, specifically addressing retirement investing and the convenience of balanced funds and target date funds, TDFs. He presents data showing the remarkable long-term success of a low-cost 60-40 balanced index fund, which delivered significantly higher returns than its actively managed peers, primarily due to its low cost. He also discusses the concept of target date funds, which automatically adjust their stock-bond allocation to become more conservative as the investor nears retirement. While endorsing the simplicity of TDFs, he cautions investors to look under the hood to ensure they are using low-cost, index-based funds, not higher-cost versions with actively managed components. He also introduces a crucial, often overlooked factor in retirement planning: Social Security. He advises investors to view their future Social Security benefits as a bond-like asset, which should factor into their overall stock-bond allocation to avoid being overly conservative.
Consider a balanced or target date fund. For investors who want to simplify their portfolio and automate their asset allocation, these funds are an excellent option. Compare costs on TDFs. Not all target date funds are created equal. Choose low-cost, index-based TDFs over their actively managed counterparts. Factor in Social Security. When you're nearing or in retirement, treat your future Social Security payments as a significant bond-like asset. This will help you maintain a more appropriate stock allocation for your overall financial picture. Chapter 20. Investment Advice that Meets the Test of Time. In his final chapter, Bogle brings all the book's themes together in a powerful conclusion. He summarizes the core common-sense realities of investing. Start early, minimize costs and taxes, diversify widely, and ignore market timing. He emphasizes that the traditional index fund is the only investment that guarantees you will earn your fair share of the market's returns. He closes by channeling Benjamin Franklin, drawing a remarkable parallel between Franklin's timeless maxims on saving, frugality, and perseverance, and Bogle's own investment principles. He highlights Franklin's "a small leak will sink a great ship" to illustrate the power of compounding costs, and "if you would have a faithful servant, serve yourself," to argue for being your own advocate. The chapter is a call to action, to reject the "don't just stand there, do something" mentality of Wall Street, and adopt the diametrically opposite winning strategy of "don't do something, just stand there." How to apply these lessons in your daily life. Create a Franklin-esque plan. Develop a simple, long-term investment plan based on Bogle's principles. Document it and commit to sticking with it. Revisit your principles regularly. Whenever you feel tempted to react to market news or a hot investment tip, read the summary of this book or a few of your favorite quotes. This can serve as an emotional check. Be a long-term winner. Realize that the true measure of investment success is not beating the market, but capturing its returns over your lifetime. By following Bogle's simple, common-sense advice, you are almost certain to be a winner. The book's main idea condensed. The Little Book of Common Sense Investing presents a powerful, evidence-based case for a simple investment strategy that guarantees an investor's fair share of stock market returns. The core idea is to own the entire stock market through a low-cost, diversified index fund and to hold it forever. Bogle argues that active management is a loser's game for investors as a group because the high fees, commissions, and other costs paid to financial intermediaries inevitably erode returns. He stresses the magic of compounding returns and warns against the tyranny of compounding costs. By embracing a buy-and-hold strategy with a low-cost index fund, investors can avoid the pitfalls of market timing, performance chasing, and emotional decision-making, ensuring long-term financial success.
If you enjoyed the content, please consider supporting the author.
Thanks for watching, and if you like this video, subscribe. Now, let's go to the next video.